Hi, hello, good evening, guys. Can you please confirm if the audio video setup seems okay to you? I can see Karan on the chat box, Karan, Krishnan, Sakshi. Hi, Mohit, Karthik. Hi, good evening to you. Hi, Lavina, Krishnan. Okay, fantastic. Okay, got it. Kasikai, Monday, how are you guys doing? Happy Dasera to all of you, by the way. All right, so welcome to all of you for this FRM crash course, day one of the session. I'm going to take first 10-15 minutes. We'll talk general. I'll explain structure of the crash course in terms of how I'm planning to do it. I'll also explain how you can make use of the crash course as well. Some general tips, and then we're going to get started with the topics right away. So let's fire up. By the way, Saurabh, if you could come on the YouTube link directly, because I'll not be monitoring any chats on the Zoom box today. So it will be better if you directly come on the Zoom link itself. All right, let's start. Can you, just to get started, can you give me dates of your FRM Part 1 exams? I'm guessing most of the candidates attending today would be the November candidates, but we do have, some enthusiastic May candidates as well. Can you type down the date on which you're taking the exams? Correct, 5th to 18th. So when is your exam scheduled? Understood. So we've lot of people around November 16, 17. We've some people very close around November 5 as well. Got it. See, here's what I'm going to do. I originally planned a 3-day crash course, but after doing a little bit of digging and fine tuning, I figured that, okay, I just switched my camera. Yeah, so I figured that a 5-day format would be better as against a 3-day format. So now we would be spreading these sessions over 5 days. We would be doing approximately 4 to 5 hours each. We would be starting at 5 p.m. on a daily basis. I'll give you a calendar as well. So in terms of timeline, instead of 3 sessions, now we're doing 5 sessions. We're doing roughly about 4 hours each. We're doing session today, tomorrow, and day after tomorrow. So today is what? Wednesday, right? So we're doing session on this Wednesday, Thursday, Friday. And then next week, I would be doing 2 sessions with you, again on Wednesday and on Thursday. Okay, so 3 sessions this week, 2 sessions next week. Every day the session is going to be 5 to 9 p.m. We'll be starting at 5. We might extend a little bit, maybe go till 10 as well. But you're looking at about 5 sessions. Now, you have 2 options. You can either decide to do this crash course live if it fits your timeline. But if you're watching this in the future, you can also consider, you can also do video archives, because the content is going to be same. We're not going to do much of an editing. So you would end up getting these 5 odd videos. You can review them later on and revise through your content, right? So you have both the options available. Now, the way I'm planning to split these 5 days is, today is the day 1. On day 1, I'm going to do all the derivatives related trading from book 3, which is financial markets and products. I'm going to follow a learning outcome approach as against a topic approach, which means we will take one reading and then we will do all the learning outcomes in that reading sequentially. The thing is, based on the candidate feedback, the last 3-4 FRM exams, they have had a lot of qualitative orientation as against quantitative. What I mean by that is there have been a lot of theory questions on the exam. So I have kind of calibrated my crash course accordingly. I've also put in a lot of important theory sections so that no matter what kind of paper shows up on the exam, you feel reasonably well prepared. So day 1, we do derivatives from FMP, which is today. On the second session, we would be doing the remaining part of derivatives from VRM, and we would be doing fixed income sections from FMP and VRM. Day 3, we would be finishing the fixed income section, which is a relatively large section with some computational and qualitative areas as well. On day 4, we would be doing quant, which is the book 2 in entirety. And we would also be doing portfolio management from book 1. There are 2 readings in your book 1, which are slightly more quantitative in orientation. So we'll be doing them. And then on day 5, we would be doing the theoretical sections of book 1, and then we would be doing all of the theory readings. Okay, so this is how the sessions will be structured, which means you're looking at total 5 videos in the archive, and then you can just watch these videos as day 1, day 2, day 3, and then you're good to go. Now, in terms of how to use this crash course, you attend these sessions either live or you do the video archives, whatever works for you. If you're in a situation where you are available in these time slots, 5 to 9 p.m., 3 days this week and 2 days in the next week, then you're welcome to do them live. Otherwise, then you can catch up with the archives later on. I have prepared exhaustive notes based on learning outcome, which are separate from juice notes. Okay, so I've made dedicated notes with all the theory bits and pieces. I will be making these notes available on the FinTree website under the crash course page in a downloadable PDF format on a day-by-day basis. So you don't have to worry too much about writing down the stuff. The focus has to be more on learning. And these notes will also come in handy a day before when you want to revise for the exams. What I'll suggest you do is, when you're going through this crash course with me, there will be certain parts where you feel like, I have no idea what he's talking about, or maybe I have not reviewed this particular section. Okay, so what I want you to do when instances like these occur, because I'm mapping them very closely to the learning outcomes, all that you have to do is make a list of areas that you're not comfortable with. Keep on attending the crash course. Don't give up midway. Don't say that, let me go back to the books, do this section and come back to the crash course. Don't do it. Keep on attending the crash course. Make a list of all the areas that you're not comfortable with. And then after the crash course gets over, hit those relevant sections. So it will also help you figure out what areas you're not comfortable with. So make a list of all the areas and topics to review later. And then finally, you're going to make use of these notes that I share with you to revise a day before the exams. All right, now, the topics that I would be covering today, let me put them on my screen. These are the readings that we're going to touch base on. My chapter numbers might not be precise, but the reading numbers are. So we would be starting with Introduction to Derivatives, Theory, Basic, Simple, but I'll still be taking you through those smaller theory sections. Exchanges in OTC. Then we would be doing future markets, using futures for hedging, foreign exchange, pricing of forward, commodity forwards, options, properties of options, trading strategies, and exotic options. During our live sessions, we did not spend a lot of time on exotics. So during the crash course, I might be spending a little extra time here, almost like a full-fledged session to kind of make you comfortable with this topic. Right? That's the agenda for day one. In general, during the session, I would appreciate if you guys are participative. Prajay, Shilpa, Dor, Mamu, Itachi, Manvi, Krishnan. So keep on, asking questions throughout the session. Keep on raising queries. I'll try and answer as many as I can. We would use a command word. We would use a command word for the session, which will be, if you guys know, I have been using this for a while, called iPass. So every time if I ask you, and I'll be asking you a lot, means I kind of thrive on your feedback. So every time if I ask you, samjha ya nahi samjha, did you understand or not? Are you comfortable or not comfortable? If your answer is an affirmative, all that you need to do is you need to give me a large, loud iPass. Every time you type in iPass, I want you to believe in it. So let's do a small demo. Give me a large, loud, roaring, roaring iPass on the box. iPass, Chichi, you said all the code words. Oh yeah. You know what? That's cringe for me now. Yeah, iPass works pretty well. All right, fantastic. I love the enthusiasm there. Good. Okay, understood. Very nice. So should we start now? Manvi is saying conduct a crash course for CFA level 1. Manvi, I already did a crash course for 2021 syllabus. It's already sitting on the YouTube. The syllabus is almost the same. So you can go and just have a look at it. Should do the job, I guess. Okay, give me a minute. I'm setting up my writing tablet here. Okay. Let's start. Here's your reading number 1. Derivative markets and securities. As I told you, there's a lot of theory. I've made my notes in Microsoft Word. I will be sharing this in the format of a PDF with you towards the end. I've put in all the pieces which I thought were important from a theoretical perspective. And I would be kind of fine-tuning this PDF or Word file as we progress. Okay. Initially there will be certain parts where you'd feel like this is too basic, I know it, but as we progress, automatically the technical sections will also start coming in. So with this, I'm starting. This is your learning outcome. This is your reading name, Derivative Markets and Securities. This is your learning outcome 1. Can you guys confirm if the font size is good enough for you? My screen is properly visible. Is the font size good enough? Can you see my screen properly? I think if you've logged in from a computer or a larger screen, it should be okay. If you're on a mobile phone, maybe the screen size would look a little smaller. All right, fantastic. Okay, here we go. First learning outcome, define what's a derivative. Define derivative, describe the features of the derivative, and compare linear and non-linear derivative. By the way, I don't know if you know this, but these are typically referred to as the command words. Okay, define, describe, compare. These command words will give you some sort of a perspective of what kind of questions can you expect from that learning outcome. So whenever you're revising, you want to kind of have an eye on what were the command words in the learning outcome. For example, define, describe, and compare are mostly qualitative and theoretical command words for questions. So you know that there are no formulas or no calculations involved here. So we know what a derivative is. It's a financial security that derives its value from some another security. That another security typically is called underlying asset. Now, what do we use it for? We use it for hedging purposes. We use it for speculation purposes. So we use it for hedging. We use it for, let me rather just highlight this here. So we use it for hedging purposes. We use it for speculation purposes. We use it for diversification of the exposure. If I've concentrated again, type of hedging in a way, it can be added as a feature to the bond. I'm sure you've heard of convertible bonds, you've heard of callable bonds, and all that kind of stuff. You must have heard of employee stock option plans. So employee compensation, or at times certain projects by themselves behave like options. Okay, we like in the world of corporate finance, we call them as real options. So where the business itself behaves like an option, so we call them real options. Okay, just a word. I don't think it's testable, but you should know. What's important in this learning outcome is the difference between a linear derivative and a non-linear derivative. Now, can anyone tell me an example of a non-linear derivative? What's the difference between the two? A linear versus a non-linear derivative. So a linear would be a little bit like this. Give me an example of a linear derivative. A linear derivative would be your traditional forwards or your traditional futures. Right? These are examples of linear derivative. What could be a non-linear payoff? A non-linear derivative would typically be you're looking at options, right? Because of the inbuilt asymmetry that exists there. In case of forward, it goes up, it goes down, you have equivalent amount of losses. But in case of options, let's say a call option, if the underlying goes up, you make profit, but if it falls, your losses are not unlimited, right? They're capped up to the amount of premium that you've made. So linear versus non-linear derivative, something that you want to keep in mind. All right, taking you to the next learning outcome. Now we want to look at the difference between an exchange traded versus OTC product, advantages, disadvantages of each one of them. So we know that exchange traded are more standardized products. Typically, they do not have any credit risk per se, whereas an OTC product is a more customized product, great for hedging, larger ticket size, but will have a little bit of credit risk inbuilt into it. So Let's see what we have here. There's an open outcry system, which is a fairly old system. Open outcry means traders standing on the pit floor and maybe shouting or doing hand signals and then booking the trade. We've all seen that in the movie. That's called an open outcry system. Fairly old, used at very few places in the world, and especially even during COVID, a lot of open outcry system moved to the electronic systems. Electronic trading is what you see on the exchanges, right? So electronic trading is what you and I do, buy and sell on exchanges. OTC typically is more of an institutional platform. OTC is more a platform for institutions, larger ticket size products. Typically, there are dealers involved in a OTC trade, right? So dealers are acting as at times counterparty for an OTC trade. The dealer will maintain a bid and offer price. In general, I want you to have a good understanding of what a bid and offer means. Can you tell me which one is higher? Is bid price higher or offer price higher? What's a higher price? Is it bid or is it offer? A bid, ask, also called as offer. So bid means, bid is the price at which the dealer will buy from you. Bid is the price at which a dealer will buy from you, and ask is the price at which dealer will sell to you. Now, obviously, dealer means dealer will want to buy from you at a cheaper price, sell to you at a higher price. So you're looking at an offer price always greater than the bid price, right? That's in general the context of bid and ask. There is also called as a spread, a bid and ask spread. How do you calculate that? You calculate that as a ask minus bid if you want to do it in dollar amount. If you want to do spread in a percentage term, okay, if you want to do a bid and ask spread in a percentage term, you're going to do ask minus bid as a ratio to mid quote. Okay, what's a mid quote? Mid quote is nothing but an average of bid and ask price. Okay, so you can do bid and ask spread either in dollar amount or you can do it as a percentage, which is ask minus bid as a ratio to mid quote. Okay. OTC market is several times the size of traditional market. So we know that OTC markets are fairly large. What are the advantages of OTC market? They are customized contract, correct? So there is a little bit of flexibility in terms of how you would want to execute the trade. Now, after the 2008 crisis, now even within OTC trade, and I hope you're listening to me carefully, this is important. Even within OTC trade, they've learned to distinguish between a standardized OTC trade versus a non-standardized OTC trade. Okay. Now, if there is a standardized OTC, for example, a interest rate swap and an index CDS, these two products typically fall under this category. I'll write it down for you. You can also write down an interest rate swap and an index CDS trade. Okay, so typically these two products. So when these two products are traded, typically they are now traded through a centralized counterparty, which kind of works like a clearinghouse. So the structure is almost same, which means there is an initial margin, maintenance margin, variation margin. So the credit risk is reduced significantly. So even within the OTC ecosystem, we have to distinguish between a standardized versus a non-standardized OTC trade. Typically, you're looking at interest rate swaps and an index CDS trades. Okay, these are going to fall under the standardized OTC space. Okay, moving on further. Now, there is a greater anonymity in case of OTC. You don't necessarily need to know who the counterparty is. Typically in a standardized type of a setting. What is the disadvantages? Disadvantages is a credit risk if you are dealing with a non-standardized OTC product. So credit risk if you're dealing with a non-standardized OTC product. All right, that concludes our second learning outcome. The next one is the difference between options, forwards, future contract. You guys know most of the stuff, so I'm not going to spend time doing basics with you. But if you need a primer on basics, you can go and look up some of my basic videos on derivatives, right? But I'm going to assume that you know the basic difference between options, forwards, and future. Within options, something called as an American style versus an European style. Answer my question. If a contract or if an option can be exercised only on the maturity and no other date, what type of option I'm dealing with? If an option can be exercised only on the maturity and no other date, what kind of option I'm dealing with? Is it American or is it Bermudan? Is it European? If an option can be exercised only and only on the expiry, only and only on the maturity, what option I'm dealing with? That's correct. So let's assume that this is the total maturity or total expiry of the option. If it can be exercised only here, then we're dealing with a European option. If it can be exercised through the whole spectrum, if it can be exercised anytime from the date of purchase till the date of expiry, then which option is this? If it can be exercised anytime, we're dealing with what type of option? We're dealing with, come on, help me out. We're dealing with American option. And if it is exercised on certain dates in between and on the expiry, if it can be exercised on a few pre-specified dates in between and on expiry, what option I'm dealing with here? So it's neither European nor American. What option is this? If it's somewhere in between the two, this option, come on, help me out. This is referred to as a Bermudan option. Right? So three varieties of option. Bermudans are typically OTC products. European, American could be OTC or exchange traded, both. Right? So we have European, American, and Bermudan style options. Okay. Now, learning outcome D requires us to calculate an option and forward contract payoff. So I'm going to set up a few examples for you. I think there's a better way to learn this thing with the help of examples. Here's my example number 1 for you. Throughout these sessions, I will be writing a lot of examples for you, and these will come in very handy when you're trying to revise. Let us say that spot price on expiry of a particular asset is 150. We are looking at a European call. The strike price of this is 170. Premium paid to purchase the option is 20. Can you figure out what would be a payoff to the long position and what would be the profit to the long position? So when you answer on the chat box, give me payoff separately, give me profit separately. Payoff to the long position, profit to the long position. Come on, this is a FRM crash course. I don't want you to be making mistakes with these questions. All right. Here's how you do it. This is an easy one. How do you do it? You would say that, okay, the option is the option here is out of the money option. Why is that? I have a right to buy at 170. Remember, it's a call option. Call option means you have a right to buy. You have a right to buy at 170. Price of the underlying asset is 150. I am not going to buy. Price of the underlying asset is 150. I'm not going to buy. Why would I buy a 150 worth of asset for 170? So it's an out of the money option. Out of the money option, payoff is going to be 0. But hey, remember, we paid a premium of 20. So because we paid a premium of 20, my profit or loss here is going to be negative 20. That means I'm going to lose the entire amount of premium that I've paid. These are the payoff to the long position. Now, can you tell me what would be the payoff to the short position and what would be the profit of the short position? What's the payoff of the short position? What would be the profit of the short position? Some of you getting this right. Payoff and profit. That's correct. Remember, derivatives is a zero-sum game. Right? What do you mean by zero-sum game? It means profit of one party is the loss of other party. So in this instance, the payoff of 0 is going to be the same, 0, 0. Right? And here there's a loss of 20. So here there's going to be a profit of 20. That's how you figure out payoff of the call options. Easiest way to think is you say that I have a right to buy. I have a right to buy at 150. Price in the market. My mistake. I have a right to buy at not 150. I have a right to buy at, how do I delete this? Okay. Forget it. I have a right to buy. I have a right to buy at 170. Price in the market is 150. Will I buy? The answer is no, I will not buy. Option is out of the money. So 0 minus 20, 0 plus 20. All right, let's do one more example. Let's see if you can handle this one. And do 2 examples on options and 1 on forward. So here's your example number 2. Let's say strike price. I'm using standard convention now. Capital X. Strike price is 2000. Spot price is 2300. This is a spot price on expiry. Premium paid is 200, and it's a European put. It's a European put option. I want you to give me a payoff for long put payoff, and profit for long put. Profit for long put. Start. Remember, it's a European put. Strike is 2000. Spot price on expiry is 2300. You paid a premium of 200. Give me a payoff. Give me a profit. I'm going a little slow initially, but as we progress, I'll pick up the speed. Right? I'm just getting you comfortable with the scheme of things. It might look like it's going a little slow, but we'll build beautiful momentum as we progress. All right. So again, I have a right to sell. This time around, it's a right to sell. Remember, put option, right to sell. At what price? 2000. What's the price in the market? Price in the market, 2300. Does it make sense for me to sell? Does it make sense for me to sell? No, right? I should not sell Why should I sell 23 worth of asset for 20? So therefore, this is again an OTM option. I'm not going to exercise. Payoff is going to be 0. I lose the entire premium that I paid. I lose 200. Now, if I have to do the same thing for short position, all that I need to do is invert the signs. So this will be 0, 0, and this will be plus 200. That's it. All right, one final example. We'll do it for forwards. This is going to be easy. Example 3. Let us say we have a short forward position. In short forward position, you have a contract price of some particular asset, let's say at maybe 5,000. And the spot price on maturity is maybe 7,200. Give me a payoff on expiry, payoff on maturity to the short position, and profit and loss to the short position. Give me a payoff and profit and loss. It's a short forward contract. Come on, short forward contract. I want each one of you to participate, be active during the crash course. It's not your Netflix show. We have exams coming your way very soon. Think about it. You have a right to sell at 5,000, price in the market 7,200. Will you sell? Will you sell? I have a right to sell at 5,000, price in the market 7,200. Will I sell? Will I sell? So the answer is that, hey, it's not an option, it's a forward. I don't have a choice, right? It's a right and obligation both. So I don't have a choice but to sell. If I do a cash settlement, then all that I need to do is I need to sell something at 5,000, which is worth 7,200. So 2,200 negative, and obviously that is also going to be my profit and loss on the short position. Understood? Okay, moving forward now. Next learning outcome, differentiate between hedgers, speculators, and arbitrageurs. Hedgers are trying to hedge the risk. Speculators are speculating and trying to profit from their views. Arbitrageurs are trying to kind of exploit market discrepancies and mispricing and make some bucks out of it. Next one, calculate the payoff from hedging strategies involving forward contract and options. Now, this one is an interesting one because on the exams, they can frame some really hands-on question on this. Okay, so mostly quantitative, but I'm going to frame a few questions for you so you get a flavor of what might happen. I'm going to go a little heavy on you on this one. Let's see if you can handle this. Let us say that you're an exporter. You're an exporter, and you expect to receive. $10,000 in 3 months. Okay. Spot rate today is rupees. Let's call you an Indian exporter just to make things a little bit easy. Spot rate today is rupees 75 per dollar. Okay, we'll learn today in the currency class. When I say per dollar, it's called as the base currency, and I'm quoting it in 75 rupees. It's called as the price or a quote currency. Okay, so that's the spot rate. Now there is a 3-month forward available okay, at a price of, let's say, a mid-market price of rupees 72 per dollar. Okay. Now, if unhedged, in 3 months, spot rate became rupees 79 for a dollar. Now, as a hedger, you have two options. Okay. Option one, do not hedge. And if you do not hedge, then what is the rupee realization for you? If you do not hedge, what's going to be rupee realization for you? Option two, you decide to hedge. And if you decide to hedge, then what's going to be the rupee realization for you? Understood the question? You're an Indian exporter. You expect to receive $10,000 in 3 months. Today's spot rate is 75 per dollar. 3-month forward is 72 per dollar. If unhedged, 3-month spot may become or has become rupees 79 for a dollar. What's your realization in either case? Give me what's your realization in rupee in option 1. What's your realization in rupee in option 2? You can also give me what direction of the forward contract we should do. Should we do a long forward? Should we do a short forward? Okay. Here's how we're going to do this. If we were to decide that we were not going to hedge, let me just keep on saving the file. If we were to decide we were not going to hedge, then we will be able to convert $10,000 at the rate of rupees 79 for a dollar. Correct? At the rate of rupees 79 for a dollar. So that would be 790,000 rupees. If we decided to hedge, then obviously we are going to lock in that rate at 72 per a dollar. Correct? So $10,000 at rupees 72 for a dollar, my realization is rupees 720,000. So in the hindsight, which option looks better to you? Option 1 or option 2? In the hindsight means knowing that the rate turned out to be 79. Which option looks better to you? Is it option 1 or is it option 2? Is it option 1 or option 2? Obviously option 1, right? Because option 1 is giving you a better payoff. But we did not know 3 months in advance that the rate is going to be 79. Correct? Had the rate become, let's say, 71, 68, had the dollar depreciated quite significantly, then maybe option 2 would have resulted into lower payoff. So the reason why you want to do hedging is not because you would always get better payoff, but the reason why you want to do hedging is so that you want to kind of deal with the uncertainty of the cash flow. So the benefit of hedging here is that as an exporter, you know how much cash you're going to receive, right? That's going to be the benefit. Okay. And by the way, which direction should I book my hedge in? And that's very interesting. So here's how I want you to think of it. And this is going to be very important throughout FRM part 1, even part 2 exams. This logic will come in important, right? Remember that exporter was going to receive dollars. Now, once exporter receives dollar, exporter will like to sell dollars in the market. Now, you always want to take a decision in the context of base currency. Okay, and remember this, your decision is always in the context of base currency. So in currency world, when I say that you're selling dollars, it also means you're buying rupees. You're selling dollars, which is same as you're buying rupees. So then should I do a short forward or long forward? How do I decide? So you decide based on what is the base currency of the quote. In this case, what was the base currency of the quote? The base currency of the quote was, remember I told you, for $1, 75 rupees for $1. So dollar was given as the base currency. So here your base currency was dollar. So then your decision is that I have to sell dollar. That means I have to build a short forward. Had I given you the same question, but if the base currency was given to you as rupee, okay, if the base currency was rupee, then your answer would have been long forward, because you have to buy rupees and you have to sell dollar. Is that clear? Have you understood what I'm trying to do here? How do you decide when to take a long position versus a short position? Come on, give me an eye pass on the box if this is understood. All right, good. Good. All right. Then comparing payoff from speculative strategies, similar stuff, exactly similar stuff. You have to do the same calculation in terms of how payoffs typically will work. So I'm going to leave these notes. I'm going to leave these examples in the notes for you, but this is a fairly straightforward example. So I'm going to skip through this one. Then next learning outcome is about arbitrage opportunities. Next learning outcome is about arbitrage opportunity. It is, buying in one market, selling in another market. In either case, you want to make more money than your cost of borrowing, typically assumed to be RFR, right? Arbitrage means riskless profit. Then what are the risks of using derivative? I think this is the last learning outcome here. What are the risks of using derivative? So if the markets go in the wrong direction, right, then you kind of lose a lot of money. All of you must have heard of the story of the Bank of Bearings, right? Nick Leeson, who lost a lot of money because the markets went in another direction. Then you were supposed to use derivative for hedging, but some trader in your firm or some hedger risk manager use derivatives to speculate. Okay, so if some trader uses derivatives to speculate, then obviously there could be catastrophic situations. Now, if you're a trader overbooking the trades or trader not, okay, Satya, I'll repeat the currency part one more time. Let me just finish this point, then I'll revert back to currency. See, if your trader is overbooking the trades, or if your trader is not acting as per policy, what type of risk is that? A derivative trader or a trader not following the positional limits, or trader building bigger trade than what they were supposed to do, what type of risk is this considered? This is considered as, and remember this theory question, this is your operational risk. Okay, so trader building excessive positions, trader building excessive positions or overstating the limit, This is a part of your operations risk. Kind of have that in mind for your theory questions. Okay. Now I'm going to circle back to the currency bit just for a minute. Explain when to do long and short. Some of you are a little confused there. That's okay. You should be all right. Just give me a minute. Okay. See, here is how you do it. I'll give you a few examples. This should be just like there. Let us say that you want to buy Australian dollar 10,000. Okay. Now, if I give you a quote like this, if I give you a quote which is Singapore dollar 1.5 per Australian dollar, Singapore dollar 1.5 per Australian dollar. And if I ask you, are you going to build a long forward or are you going to build a short forward? What direction are you going to take on the forward contract? Okay, so the way you want to think of this is you want to think that, okay, by the way, you want to sell. I forgot the word sell. You want to sell Australian dollar 10,000, Singapore dollar, the exchange rate is Singapore dollar 1.5 per Australian dollar. Okay, so here's how you're going to think. You're going to think that selling Australian dollar is same as buying Singapore dollars. So then should I do a long or short? That depends on what's the base currency. So my base currency in this quote, okay, my base currency here is per Australian dollar. Remember, per Australian dollar. So 1 unit of currency, that's your base currency. So my base currency here is Australian dollar. So the question you want to ask yourself is, what am I doing with the base currency? With base currency, I'm selling it. And if base currency, I'm going to selling it, then tell me what's going to be your answer. If I'm selling the base currency, should I do a short forward or long forward? I should do a short forward. Okay. So the decision is always taken in the context of base currency of the quote. So all that you need to do is you need to say, okay, what is my base currency? Base currency is Australian dollar. What do I want to do with Australian dollar? I want to sell Australian dollar. I'm going to do short forward. Okay, let's do one more example. Let us say you want to buy 50,000 GBPs, in forward market. 50,000 GBPs in forward market. Okay. And if I give you a quote like this, if I give you a quote of, let's say 0.6251 GBP per USD. 0.6251 GBP per USD. Okay. And then if I ask you a question, are you going to build a short position or are you going to build a long position in the forward market? So how will you think? The way you will think is, you will say, okay, I want to buy GBP in the forward market, but buying GBP is same as what? Buying GBP is same as selling USD here, right? Because that's the pair we're dealing with. But what's my base currency? My base currency here is USD. So I have to think in the context of USD. Okay. And what am I doing with USD? I'm selling the USD. So if I'm selling the USD, what position should I build? I should build a short position. So I should do a short forward. So you have to always think in the context of base currency. That's what I was trying to say. Is this understood? Come on, show me some enthusiasm here. All right, fantastic. So one reading is over. We have another 6-7 to go. This one is mostly theory. It's going to be relatively easier to deal with. Fantastic. Okay. Next reading. Exchange traded derivatives. First learning outcome, describe how exchanges can be used to elevate counterparty risk. So what exchanges do is they use a clearing process, right? And clearing process helps them reduce counterparty risk in a significant way. Now, how does the clearing work? Clearing is the process of reconciling and matching contract between counterparties from the time the commitments are made until the settlement. Okay, that's your clearing process. Now, an easier way to think of how an exchange product works, how does a clearing work, is like this. Imagine you're a trader, you would want to build a long future position. Okay. Now, there is a counterparty which would like to take a short future on an exchange. The way trade works on an exchange, if this is an exchange, you can think of exchange having a small part called as the clearinghouse. Okay, and the way clearinghouse will do is, the clearinghouse will be a counterparty of the long future. So clearinghouse will take a short future position. And the clearinghouse will be a counterparty of the short future. So clearinghouse will take a long future position. So clearinghouse is going to be the clearinghouse is going to be the counterparty. Clearinghouse is going to be the counterparty on both the side. Okay. But because clearinghouse is going to build a short position and the long position at the same time, the net exposure of the clearinghouse is going to be zero. Clearinghouses will not keep any outstanding exposure whatsoever. The net exposure will be zero. Okay. But think, what's the benefit of this? The benefit of this clearing process is, if I'm a trader, I don't have to worry about the credit risk of my counterparty when I'm on an exchange, right? All that I do is go and book a trade, and I know that there's going to be no default because my counterparty is a clearinghouse. And what clearinghouse is essentially doing is, it is becoming counterparty on both the sides. That way, it is reducing the risk in the system. Okay, so I hope you're getting this is making sense. Now, typically, there is a margining process. The margining will require you to post initial margin and maintenance margin or variation margin. In one of the separate readings, we'll do all calculations on all the margin calculations there. Initial is what you post it upfront. Variation is what you do on a day-to-day basis. Okay, so right now I'm not going too much into depth. We will do that at a later stage. Then there's a process of netting. Netting means, what we used to do in college as kids. मेरा इसके पास 5 रुपया है, तेरा उसके पास 3 रुपया है. Go and settle. Like, I owe this guy 5, you owe him 3. So why not, let's settle, you owe me something. So that's netting. Easier way to, there is multiple types of netting. There's a multilateral netting, there's a bilateral netting. I'm going to give you a simple example to understand this. So let's say there are 2 trades. So let me show you a bilateral netting now. Okay, so this is A, this is B, and this is trade 1. Okay, in trade 1, A owes to B a total of $7. Okay, A owes to B $7. In trade 2, B owes to A, let's say $2. $2. So bilateral netting would be, after you do the netting, bilateral means between the two parties. The simple netting will be that if this is A and this is B, this is A and this is B, then A will simply owe to B owes $5. That's it. That's your simple, straightforward bilateral netting. Okay, so instead of doing one transaction of 7, another transaction of 2, you just simply do a $5 transaction. Then there could be a multilateral netting, which is a little more complicated, but we've done this as friends, so we kind of have an idea of what this is. So imagine if this is X and this is Y, and then this is let's call him Z. Okay, so X, Y, Z. Now X owes to Y, let's say, I don't know, let me make up something random, $10. Okay, and Y owes to Z, Y owes to Z, maybe, I don't know, let me make up something like $8. And Z owes to X, let's say maybe $3. Okay, something like this. So in a multilateral netting framework, the way netting is going to work is a CCP will come in the center. So we will have a CCP involved in the center, and then we will have X, and then we will have Y here, and we will have Z here. Okay, so this is X, this is Y, this is Z. Now you have to think from each one's perspective. Let's think of X. X owes $10, but X is supposed to receive $3. So what's the net position of X? X has to pay $10. X is going to receive $3 from someone else, right? So the simple transaction would be that X now owes only $7. I was supposed to pay 10, but I'm going to receive 3. So now I owe only 7. Think from Y perspective. Y owes 8. Okay, Y needs to pay 8, but Y is going to receive 10. So now Y will kind of receive, I'm just using the word receive. So Y will receive, or supposed to receive the difference of the two, which is $2. And think from Z perspective. Z is supposed to receive 8, but Z is supposed to pay 3, correct? Supposed to receive 8, but pay 3. So that means Z is supposed to receive $5. $5. So think of it, how beautiful this structure is. Earlier it was 010, 08, 03, right? But now it is so simplified. Now X is going to pay 7 to the CCP, and Y is going to receive $2, and Z is going to receive $5. The transactions are kind of settled. So this is called as a multilateral netting. This happens when a centralized counterparty is involved in the process. Have you understood this? Okay, nice. I'm going to assume that you've understood this. So we've done most of the netting discussion here. Next learning outcome is define the netting process. Netting is combining long short position into a single exposure. If it's a bilateral netting, it's between two parties. If it's a multilateral netting, then we just saw how does the multilateral netting framework works. So hopefully you guys are clear with this. Next learning outcome, it takes us to the concept of margining. Okay, what is a margining? It's some sort of a security deposit process. There is an initial margin, then there is a maintenance margin, and then there is a variation margin, correct? So we have this margining process. Give me a minute here. Okay, let's read a little bit of theory here. This is a learning outcome. Describe the implementation of a margining process by a central counterparty. Explain the determinants and calculate initial and variation margin requirement. This example maybe I'll throw in a numerical for you. Okay, let's see if you can handle this. Now, margining works in a variety of different ways, but I'm going to give you the most standard example. Let's say the future price today is on a particular asset, let us say 400, and the multiplier is 250. Future price is 400, multiplier is 250. So initial margin is going to be, let us say 20,000. Okay. Maintenance margin is, let us say, remember it's a future contract. Margin works slightly differently here. Maintenance margin is going to be, let's say, 12,000. On day one, the asset price goes to 420. On day two, the asset price goes down to this. So day two, asset price goes down to 360. On day three, asset price goes to 380. I want you to figure out what would be the balance in margin account of long. Balance in margin account of long position. This will take you a little bit of time. What will be the balance in margin account of long position? Start. Warren is asking, is bilateral netting for OTCs? I mean, anyways, if it's an exchange traded contract, there's an automatic netting that's happening through the exchange, right? So any type of netting that you're talking about on exchange is happening automatically. It's the OTCs where you're getting it done. So, but netting is happening everywhere, right? It's happening on the exchange, it's happening on the OTCs both. Come on, guys, you got to pick up a little bit of speed. A very possible question on FRM Part 1 exam. In fact, you know what, I'm going to give it a few stars as well. I mean, if you make me guess, this is probably something that, you know, if I were writing FRM exams, I would probably put something on these lines. Not exactly like this, but something similar. All right, here's how you want to do this. Okay, the way you want to do this is you create a future price system here, and then you do a margin account for the long, and then you do a margin account for the short. Okay, now in this case, you just do margin account with the long. Now, what's the future price? 400 into 250, you're looking at 100,000. And at 100,000, how much is the margin you deposited? You deposited an initial margin of 20,000. Okay. Now, on day one, it goes to 420. So let's calculate 420 into 250. So you're looking at 105,000. Now, if you're long and if the underlying asset goes up, what happens to your margin account? Do you get money coming in or money going out? If you're long and if the underlying asset goes up, what happens to your margin account? Do you receive money? Yes, it's a profit, right? So here you receive that incremental 5,000 into your account. And now the margin balance in your account is 25,000. Now on the next day, the asset price fell to 360. Okay, so 360 into 250. 360 into 250. So now you're looking at a significant drop of 90,000. Is that correct? 360 into 250. So the price is falling down to 90,000. Now 90,000 means a loss of 15,000 here. That's the difference between the two prices. So 15,000. So now the amount left in your margin account is 10,000. But hey, at 10,000, you've reached at a level which is below your maintenance margin level. Correct? Remember, what was your maintenance margin? 12,000. So at this level, you'll have to deposit additional margin in your account, which is called as the variation margin. This will be called as the variation margin. And how much is the variation margin? So you'll have to bring it back to the initial margin level, and initial margin level was 20,000. So you have to deposit additional 10,000 here. The amount left now in your account is 20,000. And then finally on the last day, from 90,000, it goes to 380 into 250. So it goes to 95,000. It goes to 95,000. So you have a benefit of 5,000 coming in here. So you get 5,000 in your account. And then the margin left in your account here is 25,000. So this is your answer. If you got this right, give me a, or if you understood this, give me a large, loud I pass on the box. If you've understood how this math works. If you've understood this, give me a large, loud I pass on the box. Okay, good. All right, so a little bit of theory then. I'll give you a break very soon. We are just about to finish this reading. Then I'll give you a nice little break. Variation margin and Delhi's settlement are interrelated. Future contracts are settled each day during the life of the contract rather than at the very end. Correct? So the mark-to-market process is happening on a daily basis. From CCP's perspective, there are equal number of long and short positions so that CCP experiences net cash flows of zero. Net cash flows of zero. CCPs will have initial margin requirement. Initial margin is intended to cover potential losses from a member who fails to make variation margin payment or any further losses that may occur from unfavorable price changes. CCP's losses are meant to be recovered from initial margin previously paid by defaulting member. Now, this is where it gets a little technical. However, if the amount of initial margin is insufficient, the default fund contribution of that particular member are applied to cover the difference. If there is still a shortage, the default fund contribution of other members are applied. Okay, so please listen to this very carefully now. I'll answer all your queries. Just keep it on hold and listen to this. It's technical, especially if you have to do some theory questions. Imagine there is a default situation. Imagine if there is a default situation and there's a default situation, and then the CCP needs to recover the losses. So first you recover from the initial margin. That's simple. But after that, what if initial margin is insufficient? Then every clearing member will have a default fund contribution. Okay, so that's where you go to. So then if the amount of initial margin is insufficient, the default fund contributions of that particular member are applied to cover the difference. But what if the default fund of that particular member is also not sufficient? Then you use the default fund contribution of other members. This is called loss mutualization, which means it is possible, and see the real life implication of this, theoretical, but could happen. I'm a clearing member and some other clearing member defaulted. So CCP will take first initial margin of that clearing member, then default fund contribution of that clearing member. If these two are not sufficient, the CCP will then share the losses among all the other clearing members. Okay, which means I had no fault in that trade whatsoever. I had nothing to do with that. But even then, I will have to contribute to the losses. This is called loss mutualization. So sequencing, you need to remember this. I'm going to write it down. Number one, if there is a default, number one, you take initial margin of that member, initial margin of that defaulting member. When I mean member, I mean clearing member, right? So there are these members of the clearing house through which think of them as brokers who have original tickets. So initial margin of that defaulting member. Then second, the default fund contribution of the same member, of that member. So it's like some sort of a security deposit when you get a membership of an exchange or a CCP. You put in some money, a blanket money for all the trades. And third, then the default fund contribution of other members. This is referred to as a loss mutualization. Other members, this is referred to as a loss mutualization. I hope you've understood this. Okay. Now, how do they determine initial margin? Initial margins are determined by the exchange. It's a function of the volatility of the underlying asset or the future. Now, CCP will pay. Okay, this I'm going to skip. Okay, all right. Now we have to do a little bit of more. We have to do a little bit of more on this, but that would be discussed in one of the subsequent learning outcomes. So we'll deal with that whenever that arises. Now I'm just following the sequence. I'm going to skip through this now. I'm taking you to the next learning outcome. Compare exchange traded and OTC markets and describe their uses. Okay, so let's do that. Exchange traded, the usual exchange traded are the usual standardized contracts, liquid, active, regulated. In contrast, OTCs are privately negotiated bilateral contracts with little or no regulation. I mean, regulations has become more dominant after 2008. Okay, just a minute. Now, different classes of OTC derivative. So we have 5 classes here. We have interest rate. Then we have foreign exchange, equity, commodity, credit default, swap. Right? These are some of the classes of derivative. The interest rate derivative is the highest in the size. Okay, just a theory tidbit for you, but you want to kind of remember it. Interest rate derivative are largest in the size. Then the second largest are foreign exchange. The third largest is the CDS. Third largest is the credit default swap. And then we have equity and commodities. Measuring the size of the market based on the notional can at times be misleading. Okay, so there's a better alternative which is being proposed, which is transaction value, which is a more useful measure of the OTC derivative. And typically we do a ratio, which is ratio of transaction value to notional principal value. And they've given some facts in the book that historically that ratio is about 2%. So if you guys remember, like in my main sessions, we discussed that the size of the derivative has gone to about $800 trillion or $1,000 trillion, somewhere in that ballpark, right? That's notional principal. The transaction value is ballpark 2%. The transaction value is ballpark 2% of the total notional principal. The biggest one is interest. Second biggest one is Forex. And the third biggest one is the CDS, the credit default swaps. Okay, next 2 learning outcomes. This learning outcome talks about buying stock on margin without using a CCP and calculate margin requirement, identify risk associated with OTC market, and explain how this risk could be mitigated. Okay, so we have to do a little bit of margin calculations here. There are 2-3 examples that I've put in. One, when you're doing options on stocks, then you're doing short sales, and third, when you're simply buying on margin. Okay, and for each one of them, we're going to look at a separate category of example. So first, I'm going to start with the third one, which is when you're buying a stock on margin. Okay, now here's how buying a stock on margin works. Here's your example. Let us say there is a stock price of 100. Okay. You decide there's an initial margin which is being set at 40%. There is a maintenance margin which is being set at, let's say, 25%. Okay, what does it mean? It simply means that as an individual, you're buying an asset worth 40. Sorry, you're buying an asset worth 100. You're buying an asset worth 100. You're taking a loan of 60 and you're depositing an equity. You're depositing an equity. Equity means your own money worth 40. So when we talk about margins for long stock, it simply means you're taking a loan. So you're putting in 40 on your own account. That means you're taking a loan of 60. Okay. Now what happens? This is my stock price. My stock price is 100. And this is my margin balance. In my margin account, I've deposited 40. Let's say next day, stock price goes to 110. What would be the margin amount? Margin amount will become 40 plus a profit of 10. So in my margin account, I will get 50. At any point of time, I should have 25% of the amount of stock in my margin account. That's the rule. Okay. Next day, let's say this becomes 90. Can you tell me how much will I have in my margin account now? From 110, it became 90. How much money do you think I have in my margin account? So from 50, we deduct how much? From 50, we deduct, help me out here. From 50, we deduct how much? Come on, from 50, we deduct 20. So I'm left with how much in my margin account? I'm left with 30. Are you getting hang of it? Now, how much do we need? At any point of time, we need 25% of the value of the stock in the margin account. Okay. So 90 into 25%. Can you tell me how much is this amount? 90 into 25%. How much is this? How much is this? Is it 22.5? 90 into 25% should be 22.5. Okay, I hope I'm doing this right. I have 30. Do I have sufficient? I have 30. Do I have sufficient? Yes, I do, right? 30 is more than 22.5. I'm okay. Now, from 90, the stock price falls down to 70. Okay, from 90, the stock price falls down to 70. So minus 20. Now, how much do I have in my account? I have only 10. Okay, I have only 10. How much do I need? I need 70 into 25%. I need 70 into 25%. So that should be 17 and a half. Should be 17 and a half. Again, please cross check if I make a calculation error. Looks like 17 and a half. So now the problem is, now my balance has fallen below the maintenance level, right? This is some sort of a red flag here. So between 90 and 70, it looks like there was some price, between 90 and 70, there was some price where my margin balance would have fallen. My margin balance would have fallen exactly in such a way that it would have been 25%. Right? Between 90 and 70, there was some point where that crossover happened. Are you understanding this? So typically there is a formula. I don't think this is testable in FRM part 1, but I'm still giving you. So you can take the initial stock price, and you can multiply that with 1 minus initial margin divided by 1 minus maintenance margin. Okay, so initial stock price was how much? Initial stock price was 100. So 100, initial stock price is 100, and you do 100 into 1 minus initial margin, which is 60%, divided by 1 minus maintenance margin, which is 75%. So 4 by 5 should be about 80 rupees, I guess. Please cross check if my calculations are correct. So that 80 that you see here, right, which is between 90 and 70, that 80, that is referred to as a margin call price. We call this as margin call price. And what does it mean? So when you buy the stock from the broker tells you, see boss, you're buying a stock worth 100, you're depositing only 40 with me. Okay, no problem. But if the stock price goes to 80 and below, you'll have to deposit more money with me. So I'm going to give you a call and I'm going to tell you that you have to deposit more money, and therefore this 80 price would be referred to as a margin call price. Have you understood this part? I hope you have. Now moving on to the next two learning outcomes. Okay. Have we done? Okay, now we still have to do one more example. Sorry. Now you could also do options on stocks. All right. So let's do another example here. Let us say example. Let us say I want to do long position on 10,000 weekly call options. Okay. My question to you is, can I buy these options on margin? Can I buy these options on margin? Now, typically margin is used in two contexts. So can I buy these options on, let's say, loan from my broker, or margin? I want to buy 10,000 weekly call options. Can I buy these options on loan or margin? The answer is no. Why is that? Because you know that options are already leveraged product, already bought loan hai usme. Right? There's already a very high level of leverage, so you don't want to do it again. So you're not going to get margin. You're not going to get margin on buying options. Have you ever heard someone taking a loan and buying options? No, it doesn't work, right? You don't get margin for the purchase of options. So keep that in mind. All right, next example. Yeah, I mean, some rare cases, if you are buying, let's say, a 1 year long option, in some rare cases, some brokers will give you the loan, but weekly call option, you're not getting any options. Okay. Next one. Example. Let's say I want to sell 10,000 options. I want to sell 10,000 options at 3.5 each. Okay. Do I need to deposit any margin with exchange? Do I need to deposit any margin with exchange? I need to sell 10,000 options at 3.5 each. That's the premium. Do I need to deposit margin with an exchange? What do you think? The answer is yes. Why? Because if you're a short seller, if you have a short position on option, then you will have to deposit some amount of margin with exchange. If you're doing long position, you only have a right, margin is not required. But if you're doing a short position, you'll have to deposit margin with exchange. And why is that? Again, just to summarize, if you are long on options, you only have right, no obligation. Correct? But if you're short on options, if you're building a short position on option, you have an obligation. And because you have an obligation, you will be required to deposit some sort of a security deposit with an exchange. So you'll have to deposit some sort of a margin. Okay, moving on. We're almost towards the end of this reading. Next learning outcome, role of collateralization in the OTC market, and compare it to the margining system. So more or less it works the same way. The way we have margining system with exchange, we have a collateralization system with OTC. More or less it works the same way. Now, typically in your ISTA, you would have an CSA or credit support annex attached to it. Correct? This CSA will talk about the type of collateral, and everything about collateral will typically be discussed in the credit support annex. But parties will be required to provide collateral so that they reduce the counterparty risk to some level. And then there is a simple theoretical learning outcome on the use of SPVs, or a special purpose vehicle. And why do we use special purpose vehicle? You would learn that in the fixed income section as well of the crash course. You want to use SPVs because it will provide you some sort of a bankruptcy remote vehicle. Remember this word. It provides a bankruptcy remote vehicle to you. That means it will legally separate the sponsor from the SPV, and therefore it will get you a better credit rating. Okay, so that's something that you want to keep in mind. So every time you're doing a securitization transaction, SPVs will come in handy, and that's what the reading says. And with this, the second reading is over. Okay. How are you finding my speed? Slow, fast? Okay. Are you comfortable with the speed at which I'm going? Or do you want me to sprint, go faster? Okay, nice. All right then. So let's do a nice break, about 15 minutes. I'll put on a timer for you. So go get a coffee, tea, whatever that works for you. Come back after the break. I'm going to continue with the subsequent readings. Initially, it will look like we're going a little bit slow, but that's because we're setting the fundamentals. As we progress in the course, we should be able to pick up a little bit of rhythm so that we can finish this comfortably in 5 days. There are a couple of queries that have come. Number one, is it that the option writer has to deposit margin money, not the option buyer? Yes, Pradeep, that's correct. If you're an option writer, that means a seller, you'll have to provide some sort of a margin amount to the exchange. Regarding long option, do we need to deposit premium? Yes, you need to pay premium to buy options. Premium is not margin. That's correct. Premium is different. Margin is different. So when you do short options, the exchange will keep the premium that you received, plus you'll have to deposit some additional amount. Okay. All right. 15 minutes. Let me put on a timer for us. Here we go. I'm ready when you are. So about 30 odd days left for the exam. See, in general, what I'll suggest you to do now is in next 3-4 days, if there are any readings you haven't finished, usko pehle khatam kar lo. Like all the outstanding parts, smaller theoretical readings, whatever you haven't finished yet, finish them first. Then next 30 days, you do this crash course. If required, you can watch it twice, thrice, and simply jump onto question practice. Try to do at least 5 to 6 mocks, maybe more if you can get access to them. Practice questions, make mistakes, figure out where things are going wrong, work on the weak areas, and then practice more questions. Just keep on doing it, and you'd be well prepared. Triple R, 4R, you have to bring back the margin to initial margin level of the current stock price. Okay, all right, let's start. This is great fun now. We have to do one more theoretical reading, then we kind of get into more technical stuff. Next reading. Provide examples and mechanics of CCP. We have to discuss about clearing. We have to discuss about settlement, a little bit on initial margin. There's a lot of redundancy in FRM syllabus in general. So you'd realize that the content will just keep on repeating itself quite a lot of times. I'm also editing my Word file as we go. Okay, here we go. Let's start. So first learning outcome, provide examples and mechanics of the CCP, centralized counterparty. They do clearing, they do settlement, right? Two things. Clearing refers to process between I'll keep on saving my file. I don't want to miss on these notes. I don't know how stable the word is going to be since I'm doing annotations, but let's hope it works well. Clearing refers to the process between the period from trade execution until settlement. Period from trade execution until the settlement. The period is typically short for classically cleared non-OTC derivative, exchange traded derivative. So it's a shorter window. In contrast, for OTC derivative, this time period could extend to years or even decades. Okay, fair enough. Why are they saying this? because remember, some of the OTC derivative could go as long as 10 years, maybe 15, 20 years, right? So for OTC derivative, the clearing process could be longer. Settlement of a trade occurs when trade is completed and all payments have been made and legal obligations have been satisfied. Just a simple definition for us in terms of what settlement really means. Simple, straightforward, nothing complicated. Initial margin is based on the risk of the transaction and not the credit risk of the member. Very interesting, testable. You need to know this well. Initial margin is based on the risk of the transaction and not the credit risk of the member, which means irrespective of who is the counterparty, the initial margin is going to be same in a OTC framework. Okay, so keep that in mind. GARP loves these smaller theory nuances. So I won't be surprised if they frame a question around this. So initial margin is based on the risk of the transaction. That means the product you're dealing with, not necessarily credit risk of the member. CCPs will usually set the initial margin. Let me see if I can get rid of this color. CCPs will usually set the initial margin so that there is about 1% chance that the initial margin will be insufficient to cover losses. From there, default fund contributions are utilized. Clearing members are typically large players, including large banks and global financial institutions. Now, Vikramaditya, this is the point that you wanted to discuss, right? You wanted to discuss about the auction and the default process. So here's the sequence. When a member defaults, rather than closing out the trade at the market value, the CCP will auction off the trades to the surviving members through an auctioning process. So that's step number 1. Failed auctions may allow CCP to assign losses to those who've had recent gains. Very important. Listen to this very carefully. Failed auctions may allow CCP to assign losses to those who have had recent gains, or the CCP could tear up the transaction. I'm going to highlight this for you. Oh, that's a bad color. CCP could tear up the transaction by, and I'll explain what tear up is, by closing out the defaulting member's trade. That will result in non-defaulting members incurring some losses. So both of these terms are given a technical definition. We'll see them very soon. Loss mutualization is a form of insurance and refers to members' contribution to a default fund to cover future losses from member defaults. Loss mutualization, some sort of an insurance that refers to contribution to a default fund to cover future losses. All members must contribute to the fund. The potential losses from the default of any given member are contained. All members must contribute to the fund. When a member does default, the amount that cannot be covered from members' own resources are covered from the fund. And we saw the sequence, right? Given that losses are spread among surviving members, it is possible that a member will suffer losses even if it never traded with the defaulting counterparty or had no positions with the CCP due to the loss mutualization process. So you need to know this. We have to do a little more discussion on tear up, and there's another term. We'll do that very soon. Let's look at the next learning outcome, which says describe clearing. Just a minute, I'm getting some of this formatting right. Role of CCPs and distinguish between bilateral and centralized clearing. When a CCP interjects itself as a central counterparty for a standardized OTC trade and act as a seller to each buyer and buyer to each seller. It reduces the interconnectedness of trade and the participants and reduces the risk of default or non-payment by a counterparty, right? Similar to what a clearinghouse does. And I think that's what the sentence says. CCPs operate similar fashion to a clearinghouse on the future exchanges. The next learning outcome, describe the advantages of central clearing in the OTC derivative. Let's look at some of the advantages here. Just give me a minute. Just fixing a little bit of formatting. Just a minute. Okay. So let's look at this part now. We have to look at advantages and disadvantages. We have to look at advantages and disadvantages of central clearing. These are the advantages here. Number one, default management. I'm going to give it some sort of a bullet points, easier for us to read. Okay. Default management, CCP act as a counterparty to each trade, which reduces the counterparty risk. Okay, so that's your point number one. Number two, loss mutualization. Member losses are distributed among all surviving members, which spreads the impact of losses, reduces the cost, minimize the market impact and the systemic risk. Because one party absorbing large losses would basically mean that that party might default, right? And if that party is too large, that party might go into bankruptcy. If the party is too large, it might create systemic risk in the system. What this process is doing is it is splitting those losses across multiple members. So therefore, it is reducing the impact on the market significantly. That is your loss mutualization. Legal and operational efficiency. This is easy to understand. Liquidity. Easier to close out your trade, so gives you liquidity. Certain OTC products have standardized documentation, makes life easier, and then it also increases the transparency in the market. Now, what are some of the disadvantages? So let's assign some bullet points to these. Number one, moral hazard. Now, moral hazards kind of repeat in the FRM curriculum again and again and again. You'd see this in insurance reading also. Moral hazard basically means typically whenever there is an insurance, there's a moral hazard, right? It's simple that if I'm insured, I'm likely to take more risk. If I'm insured, मैं ज़्यादा risk लेगा, right? I'll take more risk. That's moral hazard. Is a risk that one party will take on higher risk, knowing the other party bears the cost of this risk in the mutualization setting. Then adverse selection. Adverse selection means you know, all the wrong type of people will buy insurance from you. You will invite all the people who are more likely to default. So that's your adverse selection. If CCP is mispricing the product, if CCP is not calculating initial margins properly, then people who figure out that that's happening are more likely to trade on those type of product, right? That's your adverse selection. Pro-cyclicality, this is important. I'm going to probably give it a color for you to understand that this is important from an exam perspective. I'm going to throw in a few stars for you. Make sure you understand this part well. What pro-cyclicality means is, imagine that you and I do a trade, you're in trouble. Okay, so I ask you to default more margin. Now I'm asking you to deposit more margin at a time when you're already in trouble. That means I'm going to push you towards bankruptcy. So that means I'm causing that cycle, right? And if one party defaults, there's a chance the other party will default, other party will default. So that's called pro-cyclicality. So procyclicality reflects the downside of margining. It reflects a scenario where CCP increases the margin requirement in a volatile market, which may aggravate systemic risk. Then the credit risk. CCP members' ability to determine credit risk is challenging because of lack of transparency regarding the other members' trades, which puts members' default fund contribution and variation margin gains at risk should other member default. That is unlike bilateral clearing where the risks are more transparent. Again, easy, right? If I'm trading with you, I know what your situation is. I can charge margin accordingly. But if I'm trading through a CCP, my counterparty is CCP, not that other party. So I cannot calibrate the initial margin calculations. That's the difference. Therefore, if you're doing a trade through the CCP, you don't know who the counterparty is. Your initial margin are set by the CCP, not yourself. Whereas in a bilateral setting, bilateral means just you and me. Then I can calibrate the margin requirement depending on what is your credit scenario. Okay, next learning outcome. Explain the regulatory initiative for the OTC derivative market and their impact on central clearing. The key regulation emerged from G20 leaders meeting in September 2009. There are two parts to it. In fact, three parts here. Let me just get this in order. Okay, here's part number one. All the standardized OTC must be cleared through the CCP. All the standardized OTC must be traded on electronic platform, and all the OTC trade must be reported to a central repository so that there is information available in terms of what type of trades are happening in the market. Now we are looking at two primarily products which are used for standardized trade. Just again, give me a minute here. So we're looking at two products. Number one, a plain vanilla interest rate swap. That's a standardized OTC product. And second, I told you, credit default swap on indices. So if you're doing one of the two trades, then they are called standardized trade. They have to be routed through CCP. They will be on an electronic platform, and all the reporting will happen on a centralized trade repository. Okay, now going to the next learning outcome. Compare margin requirement in a centrally cleared trade and bilateral market and explain how margin can mitigate the risk. Central clearing applies to standard transactions only. Standard transactions involving a given security have four key attributes. Okay, so let's see what are the four key attributes we're looking at. Standard and legal economic terms, widespread models to value the security, active trading to ensure ease of unwinding, long price history to determine the initial margin. In contrast, non-standard transactions are cleared bilaterally and deemed uncleared. Okay, I'm just going to delete this part. Non-standard transactions are cleared bilaterally, whereas standardized transactions are cleared through a CCP. Just like a centrally cleared transaction, uncleared transaction between two financial institutions are also required to post initial and variation margin, which is a notable departure from the past regarding the initial margin. Now, what does this thing mean? It means prior to 2008, it was okay not to do a lot of margining on non-standardized trade. In fact, there was no such thing as standardized OTC versus non-standardized OTC prior to 2008. And there was no requirement for depositing any initial margin. The parties by themselves could do that, but it was not a legal requirement. But now it is a legal requirement to post initial margin even on a non-standardized trade. Then novation and netting. So compare netting in a bilaterally versus centrally cleared. This part we've already discussed. The legal process of interposing CCP between seller and buyer is called novation. Okay, novation means creating a new contract, and it's a simple contract. It's a simple process. I'm going to do an example with you. Just give me a minute. Okay, so think of it this way. Let's create a nice little drawing here. Easy concept. See, let's say A and B have, trade between them. Okay, this is A, this is B. They're trading with each other. What would be a novation? After the novation, the trade between A and B is cancelled. Okay, and there are new trades created. What is a new trade created? There will be a trade between A and CCP, and then there will be a trade between B and CCP. So replacing the old trades with the new trade, that process is called novation. That's it. It's that simple. So read this now. Through novation, one contract is replaced with another contract with the CCP. That's it. This is important because novation transforms the process from bilateral trading to trading with the CCP, where CCP is the insurer of the counterparty risk. Assuming the legal enforceability of novation, all contracts cease to exist and the original bilateral parties have no further obligation to each other. They have obligation to the CCP now. Market participants often prefer to offset rather than terminate the trades, which creates a lot of redundant trades. So if I have a long contract on some asset, instead of closing out the contract, I'm going to build a new short contract. But what that does is it creates a lot of trades in the market. Novation kind of reduces all that clutter. Okay, and that's the benefit. That's why netting is so useful. So when trades are novated to a CCP, these redundant trades become a single net obligation between each participant and the CCP. This process is called netting. Netting reduces the total risk and minimizes potential of a domino effect stemming from default of the participant. Okay, moving on. Next one, impact of central clearing for broader financial market. So when a CCP is included in the clearing process, systemic risk in the financial market is reduced, but it can be increased at the same time. Okay, why is that? Systemic risk is reduced because CCPs reduce the counterparty risk by offsetting position, provide transparency, improve liquidity. However, the potential requirement that members post higher initial margin during times of increased volatility. What was this called? This was called pro-cyclicality. Remember that word, theory question. Potential requirement that members post higher margin during increased volatility could increase the systemic risk. In addition, concentrating all trades in a single place exposes the market to the risk of CCP failure in a heightened systemic risk. And if that happens, we're looking at another 2008 type of situation. All right, what are the risks faced by central counterparties? So here we go. Identify and explain the type of risk faced by the central counterparties. So we have a default risk. Then we have model risk. Then we have liquidity risk. And then we have operational risk. Then we have legal risk. Then we have investment risk. And we're done. Okay, so these are some of the risks that we need to look at here. Again, give me a minute. Just do a little bit of formatting parallelly. Okay, let's look at some of this risk. Number one, default risk. With CCP, all members are considered equal credit risk when computing initial margin and default fund contribution. That is in direct contrast with bilateral clearing, where credit quality is explicitly considered. That's your point number one. It's an important point. It's a testable point. I highlighted that earlier. I'm highlighting it again. In the event of a failed auction or insufficient number of bids, the CCP will be required to pass on the defaulting members' losses through the right of assessment, loss allocation method, or both. Passing on losses to other clearing members may result in default by those members as well. The loss allocation method may be considered unfair because some of them, such as VMGH, variation margin gains haircutting, and tier-ups, impose losses on winning positions. So you need to know how that thing works. You need to know what VMGH is. You need to know how tier-up works. Okay. With VMGH, members whose positions increased in value will likely not receive the full amount of their gains. This is called as the haircutting. What does it mean? It means something like this. Okay, look at this. Let us say that there is A, there is a CCP, there is B. Okay. Now A has defaulted. A is in default. Now the total losses because of A's default are 50 million. Right? Now there is a C and there is a D here. They are also transacting through CCP. They have nothing to do with A and B. Now C has made a gain on this transaction, and C is expecting to receive, let us say, 200 million in variation margin. From whom? From D. But remember, it's not coming through D, it's coming through the CCP, right? So C is expecting to receive 200 million in variation margin. Now, if there is a VMGH provision, which is a part of the original documentation, what CCP will do is, CCP will take those 200 million, absorb losses of 50 million. Now, I'm exaggerating this example because imagine there would be a lot of trades where there will be gains. So CCP will be splitting them equally, not charging to only one party. But I'm just kind of simplifying this view. So what CCP will do is they will take that 200 million that C was supposed to receive through the CCP. They will charge 50 million on this, and then they will get 150. And C will be like, what? Why are you cutting my money? Why are you not paying me? It's unfair because I have nothing to do with A, right? I've never traded ever with A. So why is that happening? Because of the loss allocation rules, VMGH method, under which those members whose positions have increased in value and they are owed variation margin will not receive full amount for their gains. Have you understood this? Give me an eye pass on the box if you've understood this part. Guys, have you understood what's happening here? VMGH. Come on, give me an eye pass on the box if you've understood this. Nice. Okay, tier up. In a tier up, CCP terminates the unmatched position and may balance resources by drawing from both defaulters' initial margin and the default fund. So in a tier up, CC will terminate the unmatched position. CCP will terminate the unmatched position and may balance resources by drawing from both defaulters' initial margin and the default fund. Okay, now what does this mean? What this means is, if A and B were doing a trade, Okay, again, I'm oversimplifying this, but you would get a sense of it. A and B doing a trade. This is CCP. A has defaulted. Okay, this is B. Now, defaulted by how much? Defaulted by 50 million. Okay. Now, if A is defaulted by 50 million, that means B has a gain of 50 million on that outstanding trade. So what CCP will do is, CCP will call up B, and will say, CCP will call up B and will say, hey, that outstanding contract that you had, that outstanding contract is cancelled. Tear up. I'm tearing it up. CCP will terminate the unmatched position, because if you're not able to auction it off, if there is no one willing to take the opposite side, then you have to cancel the contract. And how will they absorb 50 million? From the initial margin and then the default fund. Okay, in the same sequence: initial margin, default fund of the defaulting member, and then default fund of the all other members. So this process is called tear up. Tear up is invoked if in auction no one is willing to assume the counterparty, no one is willing to assume the position. So if there is no counterparty, what do? Then you just simply cancel out the contract. That's it, as simple as that. Some clearing members may resign from CCP after default of another clearing member. The initial resignation may result in negative reputational impact to the CCP, as witnessed by further resignations of the clearing members. Okay. Model risk. Model risk is easy. OTC derivative are not priced by the market, but priced using valuation models. Correct? I mean, there is an Excel file, Black and Scholes. We prepared that in the class. So many different valuation models. Now, what if your model goes wrong? What if you made some error in the model? So then, your initial margin calculations will go wrong. So you have that model risk there. Liquidity risk, the usual. Operational risk, usual, technological system failure, blah, blah, blah. So all of these are usual risks. Legal risk, again, usual, there are different laws and, stuff like that. Investment risk, CCP has some money that needs to be invested. But what if they invest at wrong places? They lose money. So that's your investment risk. Okay, taking you to next learning outcome. Distinguish between the risk to the clearing member and to the non-members. Okay, now who's a non-member? Non-member means someone who has not taken the membership of the clearing house. Or a non-member means who has not taken a membership of the CCP. Can a non-member also do the trade? Yes, typically through a member. Okay, so obviously members will do the trade, but non-member can also do the trade. Non-members face exposure from CCP, clearing member, and other non-members. So non-members will face exposure from CCP, clearing member, and other non-members. If a CCP fails, a non-member may be able to avoid losses as long as its counterparty is solvent. Okay, we are talking about CCP failing. If CCP itself has failed, a non-member may be able to avoid losses as long as its counterparty is solvent. Unlike clearing members, non-members are not required to contribute to the default fund. Therefore, non-members are not exposed to losses that results from CCP failure. There is no loss mutualization that's happening to a non-member. Finally, one has to consider non-members' liability with respect to CCP loss allocation rules. It is possible that CCPs are able to pass on losses to non-members through tear up. Tear up means contract tearing up far enough that your contract is cancelled. Or it could also be the variation margin, technique that we discussed. So that's also a possibility. Okay, and we're done. Reading is over. 3 readings are done. We have about 5 or more to go. But now we get into more calculation type of reading, so we should be a little faster. Are you enjoying this? मजा आ रहा है आपको? Loss mutualization applies only to clearing members. Yes, that's correct. That's right. Should we revise with juice notes or these notes? If you have access to juice notes, you can revise with them. If you want to revise from these juice notes, these notes, you can revise with them as well. Juice notes are a little more, visual with flowcharts and all of that stuff. These notes are, bare bones, but I've added a little bit theory here. So you can figure out what you want to revise with. I would suggest if you have juice notes, that's a better way to revise. If you don't have the juice notes, you would get access to these notes directly. Yeah, if you want to revise from Schweizer's, you can revise from Schweizer's. Whatever books you're comfortable with. Just pick one book and revise from there. That's it. Don't have 10,000 different places to revise. Variation margin haircut loss by non-participating member will be recovered. Yes, if there is a variation margin haircut loss, then even non-participating members will have to bear those losses. Again, depends on loss allocation rules. That's what we discussed. All right, let's start. Let us start. So now we get into slightly more mathematical sections. So we should be able to do things a little bit faster now. Here we go. Future contract, first learning outcome. Define and describe key features of future underlying asset delivery, open interest, and all of that stuff. I'm going to assume you have basic understanding of future. Long means write an obligation to buy, short is write an obligation to sell. Open interest, the number of positions which are open in the future contract at any point of time. Remember, open interest and trading volume are different concepts. It is possible that volumes could be higher than the open interest. So keep that in mind, that the volume of trades, both options as well as future, could be higher than the open interest. Look at this sentence. Possible on any given day that a volume on a contract is higher than the open interest. These are some of the key features of the future contract. There's an underlying asset, there's a contract size, location, time, price code, price limit. What's a price limit? Price limit means there's a limit up and limit down by how much the future is allowed to move up and move down in a particular day. That's called price limit. There is also a position limit. What does that mean? Congratulations, Hardik. There's there's also a position limit. What does that mean? So you don't want a single trader, contributing 30, 40%, 10% to the, you don't want a single trader contributing to a large volume to the exchange, because then the trader can corner the market, manipulate the prices. So the exchange will set some limit that, see boss, any particular trader cannot do more than 50,000 future contracts, or cannot do more than 10% of the total trading volume, whatever, right? So there is a maximum limit set on a particular trader that's called as a position limit. So exchange will set maximum number of contracts that a speculator may hold to prevent speculators from having undue influence on the market. Okay. Now the next concept is convergence of future and spot prices. This is where we will introduce the concept of basis. I want to do this a little slow. Make sure you get good hold of it. See now, the general equation is future price, okay, is equal to spot price into 1 plus risk-free rate of return raised to the time period T for remaining maturity. Okay, that's a general equation of what a future price is. So imagine it's a 1 year future contract, okay, or even forward future is a better idea, 1 year future contract. Okay. Now, let's say the spot price is behaving in this way. I'm just drawing a random graph here. It doesn't matter how the spot price is. So let's say time 0, okay, and maybe 3 months, and let's say 6 months here, and 9 months here, and let's say this is 12 months. Okay, let's say spot price here is 100, spot price here is 110, spot price here is 130, spot price here is 150, spot price here is 180. Now, what will be the future price? We'll assume that RFR is a standard 10%. So what should be the future price? So look at this. So future price will be equal to 100 into I'm just worried that my word price should be able to handle this annotation. I'm doing this for the first time on a Word file. I don't know how well it will work. 100 into 1 plus 10% raised to 1 year. Why 1 year? Because we have the entire 1 year left to expiry. So this will be 110. Okay. So what is my basis here? My basis is calculated as the spot price minus the future price. Okay, so spot price minus the future price. Spot price is 100, future price is 110. Can you tell me what's the basis amount here? Spot is 100, future is 110. What's the basis amount here? Basis amount is going to be a negative 10. That's called basis. So right now my basis is negative 10. Okay. Now you've reached 3 months. How would you calculate the future price? So now the future price will be 110 into, I'm just writing a short form now, 1.1 raised to 0.75. Why raised to 0.75? Because remember, from 3 months to 12 months, only 9 months left to the maturity. 3 months to 12 months, सिर्फ 9 महीने रह गए, only 9 months left to maturity. So now my price will be, can you guys help me out with the math, please? I don't have a calculator though, I have a mobile app. 1.1 raised to 0.75 into 110. I'm getting 118.15. So I'm getting 118.15. All right then. So what's my basis? So my basis here is negative 8.5. How did I calculate that? Spot minus the future. Okay, spot minus the future. What happens when it goes to 130? 130 into 1.1 raised to 0.5. Why raised to 0.5? Only 6 months left to maturity now. So 130 into 1.1 raised to 0.5. It's 136.35. 136.35. That's the future price. What I'm writing inside the boxes are the future prices. So what's my basis here? My basis is going to be a negative 6.5. Difference between spot and future. Spot minus future. Next one, 150 into 1.1. Now only 0.25 of the year left. So raised to 0.25. So 1.1 under root 2 times on the calculator into 150, 153.61. 153.61. So what's the basis here? Basis is going to be a negative 3.61. And finally, here, look at the calculation, 180 into 1.1 raised to 0. Why is raised to 0? Because today is the expiry. So here the future price will be 180. And what will be the basis here? The basis will be 0. So basis on the expiry will always be 0. And this is referred to as the price convergence. Price convergence. Okay, so we are learning 2-3 concepts here. Number one, on the day of expiry, the spot price and the future price will converge with each other. On the day of expiry, spot price, future price will converge with each other. That's one. What does it mean? It means future will also be 180, spot will also be 180, which automatically means on the day of expiry, the basis will be 0. Okay, and how do you calculate basis? Spot minus the future price. Okay, is everyone okay with me? Now, how to use it, what to do with it, we're going to learn that. We are going to learn what to do with that basis risk. But I want you to learn 2 things right now. Number one, on the day of expiry, there is a price convergence. Spot is equal to future. Second, on the day of expiry, basis is 0. Third, basis is calculated as the spot price minus the future price, not the other way around. Is everyone okay with me? Come on, give me an eye pass if you've understood these 3 things, then let's move on. Okay. So basis, spot minus the future price. As the maturity date nears, basis will converge to 0. Margin requirement, same. There is an initial margin. We've already done this part. There is a maintenance margin. There is a variation margin. So good news. I told you initially we're going slow, but we've covered a lot of these areas already. The next learning outcome, role of an exchange in future contract, opposite positions, counterparty, blah, 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 blah. We've done that. Next learning outcome, difference between a normal and inverted future market. A normal and inverted future market. Okay, so it's like this. Let us say that there is some underlying asset and you see a 3-month forward contract or a future contract, 6-month and 9-month. And let's say spot price is 90, a 3-month is 91, 93, 94. So your graph will be like this. This is called as a normal future market. Okay. But if the spot price is 90 and 3-month is available at 88 and 86 and maybe 82, then as you go along the maturities, you see that the prices are going downwards. This is called as an inverted future market. That's it. It's that simple. Normal future market versus inverted future market. Nothing to it. Okay. Later on, when we learn a little bit of mathematics, you'll understand why that happens. But for the timing, just know what is what. The learning outcome says differences between normal and inverted future market. Here you go. We're done. Next one. Delivery process and contrast it with cash settlement. Again, easy. Two ways of settling a contract. You can either do a delivery or you can do a cash settlement. Cash settlement means a difference. Delivery means I'll give you the goods, you give me the money, right? Straightforward stuff. Now, there's a little bit of process with delivery which we want to learn. Number one, delivery happens infrequently. Okay, which is kind of obvious. Delivery happens infrequently. Typically, we do an offsetting trade. Let's assume that short will deliver the goods. Okay, when the long accepts this delivery, long pays the contract price to the short. This is called delivery. The location for delivery, terms of delivery, details of what is to be delivered are specified in the notice of intention to deliver document. You need to kind of know this name. A notice of intention to deliver document. That's it. Each exchange has specific rules regarding making an intent to deliver. However, the price to be paid or received will be the most recent settlement price. The first notice is, okay, this is all technical stuff. I'm skipping through it. There's nothing to it. You can read through it later on. Next, different type of trading orders. Okay, this is a little technical. We need to spend a little bit of time here. Make sure you get hang of it. Okay, come on, be with me. 30 days away from your exam. I know you're feeling already a little bit of tired, but this is what is going to differentiate between candidates who receive a congratulation emails versus we regret to inform you email. Okay, so push yourself. Don't say that I'm tired, I deserve a break. Yeah, give me your 100%. Can you do that, please? I want each one of you to commit to the course. I want each one of you to give your 100%. Be focused. When we started the session, there were about 80 odd people live. We're left with about 50. Right? That's the filtration criteria. About 45% of the candidates pass. I want you to be among those 45%. The ones who survive through the entire crash course. For a different type of trading orders. Number one, there is something called as a market order. What's a market order? You go to the exchange, you tell them, I want to sell 10,000 contracts, 10,000 stocks, whatever. I want to sell 10,000 quantity. At what price? Whatever the price. Whatever the price. Okay, that's a market order. So you just put in the quantity, you don't care about the price. That's a market order. So then the order book is filled sequentially. So there is a risk in a market order. There's a risk in a market order that you might get very bad price. Possible. That can happen, that you get very, very bad price, and that's okay, because for you, it's important to get rid of this quantity right now. So that's your priority. Your priority is execution, not price. Okay. As against this, there is a limit order. So in limit order, you would say sell 10,000 quantity. Okay. At, let's say, $50 or above, not below that. So maybe the stock price right now is at 49. Don't sell. Wait for me. But once it goes 50, then it's okay to sell. That's a limit order. So you go and sit in the limit book of the exchange. Okay. Now, if this is called market microstructure. It's a field by itself. Okay, this limit order, market order, order book. It's more of a trader's domain. But I recently read a book called Flash Crash. Okay, it was about the crash that happened in year 2010 on US markets. If you're keen on this, maybe after your exam, get your hands on this book. It's a phenomenal book. It's a book about, a teenager sitting out of London suburbs from his parents' basement and resulting into crash of the US markets. Phenomenal story. You can read through it later on after your exams, not now. So anyway, so market order, limit order. Then there are stop loss orders. Stop loss orders are straightforward that, I have bought something. I bought it at 100. If the stock price goes 80 or below, sell it at 80. Okay, so those are stop loss order. Then you can do a stop loss limit order as well. Okay, so what's a stop loss limit order? I bought it at 80. If it goes to 80, sell it, but don't sell it below 70. 80 के नीचे बेचो, but 70 के नीचे नहीं बेचना है. So if it goes to 80, put up a sell order, but put a limit of 70 so that I will not sell below 70. Then there is a market if touched order. Market if touched order is if the stock price reaches 70, okay, convert my order to a market order and then buy or sell, whatever, right? So these are called MIT orders. Then good till cancelled order. I would like to buy this stock at a price of 70. Till when? Forever. Whenever the stock price reaches at 70, please execute my trade. Otherwise, don't execute. Till the time I don't cancel. Good till cancelled. Then there are good till days and, so many other different type of orders. There's a fill and kill order. Again, traders love this type of thing. Fill or kill means give me 10,000 stocks at a price of 50 right now or kill it. So in a very volatile market, you can do these type of trades to ensure that you're getting the right price. It's a fill or kill order. It's kind of like limit, but it gets killed immediately. Either fill right now or just kill it. Okay, then next learning outcome is on accounting. Accounting for future. Okay, so what we generally do is we do two types of accounting here. Either it's a hedge transaction or it's a speculation transaction. In general, the summary of this accounting process is like this. Okay, I'm going to write down the summary for you. If it's considered as a hedging transaction, then the P&L on the future contract, okay, or whatever derivative that you have, is done along with P&L of whatever is the underlying asset that you're trying to hedge. So you kind of do them together, so it reduces the volatility. For example, you have a long position on physical gold. Okay, you have a long position on physical gold, and then you did a short future to kind of hedge it. So what happened is that the gold value went up. There was a profit of 30, but obviously you'll have a loss of 30 here. No problem. You record them at the same time, so it doesn't create volatility on your profit or loss account. Whereas if it's a speculative transaction, okay, if it's a transaction that's classified as speculative transaction, not a hedging transaction, then what might happen is that P&L of the future, okay, does not necessarily coincide with underlying in a speculative transaction. Okay, so there are accounting rules on what is speculative and what is hedging. It's very technical. We don't need to get into too many nitty-gritties, but does not coincide with underlying asset. Now, what does that mean? Imagine you have a gain of 30 here and you have a loss of 30 here. Okay, but it is quite possible that in quarter one in your P&L, you will book a loss of 30. And in quarter two, you will have a gain of 30. Now, technically, gain and loss should have offset each other in the same quarter if it was a hedging transaction. But if it's speculative, not necessary. What this does, and this is your theory question, what this does, it brings volatility on profit P&L statement. P&L means profit and loss statement. So this is what you need to remember from a theory question perspective. I hope you've understood this particular learning outcome. Okay, next one. Compare forward and future contracts. I'm not going to spend time on it. Too basic. I hope you understand the difference between the two. Customization, standardization, and blah, 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 blah. And we are done with this particular reading. Are you okay with my speed? Are you enjoying this? As I told you, as we progress, we're going to gain some momentum. Things are going to get better. We'll see, Mohit. We'll see how it goes. Okay. All right. Next reading. Define and differentiate between short and long hedges and their appropriate uses. Calculate profit and loss on a long hedge or a short hedge. Okay. So when do you do a short hedge? When do you do a long hedge? Here you go. If you have a natural long position, on underlying asset, what do you mean? Just think of it as a corn farmer. Right? Now, corn farmer has a natural long position on the corn. Okay. And you decide that to hedge that position, you will do a short corn futures. Then that's it. Then this is referred to as a short hedge. And if you have a natural short position, then you do a long hedge, right? In the same way. There's not much to it. Advantages and arguments for hedging and arguments against hedging. Theoretical learning outcome, not much to it. Okay. It is easy to see that benefit from hedging leads to less uncertainty regarding future profitability, reduction in volatility of earnings. If you're hedging, your earnings will not be very volatile. There are some other arguments against the hedging. Okay, so what are the arguments we are looking at against the hedging? Number one, it can lead to less profitability. Then questionable benefit that accrues to the shareholder. Why? Because shareholders can hedge their risk by diversifying their own portfolio. Correct? So shareholder will say, you know what, you don't hedge, we can just diversify our own portfolio. We are buying a steel stock because we want exposure to steel. So you don't hedge, let us hedge our own portfolio. And at times, and this is an important one, that it depends on the industry. And let me give you an example. Okay, so I've been talking about this in my classes throughout the period. I'm investing into this plastic manufacturing company called Shelly, okay, for quite some time. Now, what's happening? Okay, Give me a minute. I think my file has become very slow. Just a minute. Here we go. So I was saying I'm invested into this plastic manufacturing company called Shelly Engineering. Okay. Now, what does Shelly do? It produces different plastic furniture and it supplies to IKEA, among other things. Okay. It's a main supplier to IKEA. Now, the way Shelly does contract with IKEA is it does something like a cost plus, let's say 16%, let's say 20%, which means whatever is the cost of manufacturing to me, on that I will charge a 20% profit and then I will sell it to you. Now, the thing is, if you think about it logically, Shelly does not really need to hedge. Why is that? Because if the cost of plastic raw material goes up, it doesn't matter. They will still be able to charge the cost and a profit of 20%. So you cannot say that every industry needs to do hedging, right? You need to figure out whether you have ability to pass on the cost to the consumer. A lot of times, if the answer is yes, maybe hedging is not required. I'm sorry. I hope you've got the gist of it. Okay. Then we're getting into basis risk now. I'm so sorry. I've been having bad throat almost for 2-3 weeks now. Yeah, sorry for that. So now we enter into the basis risk. Basis risk is a 5-star section for FRM exams. Because you got to know this stuff really, really well. We have 2 learning outcomes here on basis risk. Define and calculate the basis, discuss various sources of basis risk, explain basis risk arises when hedging with futures. Define cross-hedging, compute and interpret hedge ratio and hedge effectiveness. Okay, so there's a little bit of calculation that we have to deal with here. Number 1, a perfect hedge are not common. Perfect hedge means, think of it this way, that I'm so sorry. Yeah. So you want to buy, a particular commodity, and you get a future contract on the same commodity with precise maturity date, and that would be called as a perfect hedge. A lot of times in real life, perfect hedges do not happen. Okay, so there are 2 reasons why this is so. Asset in the existing position is not the same as underlying asset. So you're hedging a corporate bond, maybe with a treasury bond. This is called as a cross hedge. Or the horizon may not match. You want to hedge for 17 days, but the contract is available for 21 days. So because of these 2, because of these two, it leads to basis risk. What is the basis? Spot minus the future, we just saw. What is the basis risk? Risk that the basis will change. Basis risk in a very simple language means the risk that the basis will change. Okay. Now, this is an important one. Look at this carefully. To minimize the basis risk, hedgers should select the contract on an asset that is highly correlated with spot position and a maturity that is closest to the hedging horizon. Okay, I want you to remember this. There are two conditions for minimizing basis risk. I'm going to write them down for you here. Condition number one, that you want a high correlation between the whatever is the spot, that means the underlying asset, and future contract. And number two, you want to future contract. Number two, you want to get closest maturity as much as possible. So if you want to hedge for 1 month, and if you can get a 1 month future, fantastic, right? So that's your idea. Now, optimal hedge ratio. First, probably technical formula for the day. I'm going to write down that formula for you here. Optimal hedge ratio is nothing but optimal hedge ratio. Hedge ratio is nothing but a simply beta formula from your quant syllabus. If you remember beta formula or slope formula, okay, what was that formula? It was covariance between x and y divided by variance of x. Okay, that's one formula. The second variation of this formula is correlation between x and y multiplied with sigma of y divided by sigma of x. So we take the same formula here and we apply that in the context of the future contract. We say correlation between the spot price and the future price, okay, multiplied with sigma. And this is where a lot of people will get this wrong. So I want you to listen to this carefully. Sigma of the underlying spot divided by sigma of the future contract. So future contract is coming here in the denominator. That's it. Sorry. So if you remember this, you're sorted. Correlation between spot and the future multiplied with sigma of the spot divided by sigma of the future contract. Do you think you'll be able to remember this formula? So example could be as simple as that. Let's say they will tell you that correlation between some underlying asset and the future contract is, let's say, 0.7. And then they will say that underlying asset is 1.5 times more volatile. Underlying asset is 1.5 times more volatile than the future contract. So how will you calculate the minimum variance hedge ratio? So minimum variance hedge ratio, which is same as your beta, which is same as your slope, is equal to 0.7. I might not have the individual sigmas, but I have the ratio that asset is more volatile than the future. So multiplied by 1.5. So I'm getting a 1.4 as the answer. Easy? My mistake, you're right. I made a mistake. It should be 1.05. Thank you. 1.05. What do you think? Doable? Okay. Now there are some questions on, hedging with stock index futures. So I'm going to show you some calculations there. Again, very simple. Okay, look at this. Look at how the hedging works. Here's an example. Let us say, if I tell you that you have a portfolio of $50 million, the beta of your portfolio right now is 1.2. There's a future price. Future price is, let us say, 3,400. Multiplier for the future is 250. And what you would want to do is you would want to make your portfolio beta neutral. Okay, beta neutral means you want to hedge your portfolio and make the beta 0. So how would you do it? So first you need to remember, if I have a long portfolio, then I need to do a short position. Okay, the calculation is going to be very simple. You take the portfolio value of 50 million, you divide that with one future price or one future contract value, 3,400 into 250, and you multiply that with the beta of 1.2. That's it. And this will give you a number of contracts. So let's do the math. Simple, straightforward calculations. So 50 million into 1.2 divided by 3,400 divided by 250. I'm getting 494.11. I don't know if I've done this right. 494.11. So I'm going to round it off to 494 contracts. Which position? Since I have a long portfolio, I'm going to take a short future position. That's it. That's going to be my answer. Simple, straightforward, easy. Have I made a mistake? Okay, let me do it again. 50 million. I think I did I don't know what I did. 50 million into 1.2 divided by 3,400 divided by 250. Oh yeah, 70.58. 70.58. So that's about 71 contracts short position. Thank you for correcting me. If we have a short portfolio, Pankaj, then we do long future. We go opposite side because we want to make our beta 0. So if you have a short portfolio, you'll have a negative beta. So you can do long future to add some positive betas there. Is everyone okay with this? Now, there is something called as a tailing the hedge. Okay, what's a tailing the hedge? So tailing the hedge basically means you might end up over hedging if you do not account for the fact that futures are settled on a day-to-day basis. Okay. So a hedger may actually overhedge the underlying exposure if daily settlement is not accounted for. To correct for the overhedging, a hedger can implement telling the hedge strategy. The extra step needed to carry out this strategy is to multiply the hedge ratio by daily spot price to future price ratio. Okay. In practice, it is not efficient to adjust the hedge for the future ratio. For example, if I were to tell you, continuing with previous example, that spot price was 3,100 and the future price was, let's say, 3,400. Then what you do is you would do the tailing the hedge calculation. You would simply take the previous 71 contracts, or to be precise, 70.58 contracts, and then you would multiply that with spot to future ratio. So 3,100 divided by 3,400. So 70.58 into 3,100 divided by 3,400, 64.35. 64.35. So here we would instead do 65 contracts to account for mark-to-market settlement as against doing the 71 contracts. That's it. That's called tailing the hedge ratio. So all that you need to remember is you have to do a multiplication by spot to future ratio. As long as you remember that, you're more or less sorted here. Okay, I'm going to assume that you have understood this simple, straightforward, easy calculations. Okay. Then we go to beta adjustment calculations. Again, easy calculations. I'm going to show you how these calculations work. Here's an example for you. Just get the highlight thing done first. Here's an example. Let's say currently we have a portfolio of $70 million. We have a current beta of 1.8. We would like to have a target beta, okay, of 1.1, right? We have a current beta of 1.8. We would like to reduce the beta of 1 to 1.1. The first thing you're going to remember is, if you want to reduce the beta, if the target is to reduce the beta, you're going to do a short future. Okay, if your target is to increase the beta, you're going to do a long future. That's it. Calculation remains more or less same, but short or long. Okay, so target beta is 1.1. The future price is, let's say, 2,700. Multiplier of the future is 250. Okay, multiplier is 250. So how many contracts are required? Same calculation, nothing changes. It's just that in the numerator, instead of having beta, we will have delta beta. For example, 70 million multiplied with. Now, I don't care about whether it should be 1.1 minus 1.8 or 1.8 minus 1.1. I just use this logic. Okay, so all that I'm going to do is take the difference of these two. Don't worry about what direction, doesn't matter. You can always figure out long or short here. So 1.8 divided by 1.1 divided by 2,700 into 250. So let's see how much is that. I'm going to be careful with this calculation now. So that will be 70 million multiplied with 0.7 divided by 2700 divided by 250. I'm getting 72.59. So that's 73 contracts. And which direction do I want to go? Remember, my beta is 1.8. I want to reduce that to 1.1. So I'm going to build a short position here. And there we go, beta. That easy. Is our answer matching? Have you got the logic here? Good. Fantastic. That's it. Same calculation. Nothing else. Next one. Rolling the hedge forward. Rolling the hedge forward. Okay. What do we have here? Explain how to create a long-term hedge using stack and roll strategy. Describe some of the risks that arise from that strategy. What's a stack and roll? You buy a large short-term maturity and then slowly roll it over to next month. So when a hedging horizon is long relative to the maturity, hedges have to be rolled forward as the future contract in the hedge come to maturity or expiration. Typically, as the maturity date approaches, hedger must close out existing position and replace it with new contract. This is called rolling the hedge forward, or also called as a stack and roll strategy. Okay, what is the risk? The mother of all the risk, which is called the basis risk. That's it. Okay. Now, Forex markets. Okay. Now, foreign currency will typically have a base currency and a quote currency. Quote means the price currency. Base currency is always 1 unit of currency. Please remember that 1 unit of currency is the base currency. Now, in the FRM syllabus, the standard convention that they use, in fact, in FRM syllabus, there is no standard convention, as against CFA syllabus. So if you're a CFA candidate and if you've learned currencies the CFA way, you're going to be trapped when you try to do FRM questions, because they do exactly opposite. So that's why you need to be a little bit careful with currency codes here. Okay. If you've never done currencies before and you're learning this for the first time, you're not a CFA student, you're okay. There's no problem here. I think CFA kind of oversimplifies the currency part. This is how it works in practice. So FRM that way has done a good job. Okay. With the currency quotation, logic is same. So the way, they code the currency is, they will code the currency as XXXYYY. Look at this carefully. Or XXX/YYY. The first XXX is the base currency. Now, typically in a CFA format, they do the other way around. Right? They code the base currency later on, not with FRM. In FRM, they will code base currency first and price currency second. That's the usual code. For example, look at this carefully. A code between Canadian and US dollar could be CAD USD 0.75. So what do I know? What is the base currency here? Okay. So the base currency here is going to be the Canadian dollars. So when they quote a currency like this, you need to understand, Varun, yes, you need to understand that this is the base currency. So how to read this? it reads like this, that 1 Canadian dollar will get me 0.75 US dollar. 1 Canadian dollar will get me 0.75 US dollar. So this is the base currency. This is the price currency or quote currency. This is the base currency. So you've got to be a little careful with currency convention. You've got to be a little careful with currency convention on the FRM exams. Okay. Now, typically spot quotes are given in 4 decimals. So 4 decimal is a convention. The bid rate is always lower, ask rate is always higher, right? The dealer will buy from you at a cheaper rate, the dealer will sell for you at a higher rate. So bid is lower, ask is higher. Bid is lower, ask is higher. Now forward quotes are given in something called as pips. So we call this as pips. Okay, so forward quotes are given in pips. Your curriculum is recommending you to multiply that with 0.01. I would simply recommend you to divide by 10,000. Okay, it's the same thing. I'll give you an example. Divide by 10,000. PIP stands for point in percentage. Okay, so let me give you an example of how this works. So they'll give you something like this. They will say, okay, spot price of a currency quote is like this. Okay. Oh, come on. Spot price will be a CAD USD. Bid and ask will be given to you like this. So it will be, let's say, 0.8692, 0.9135. And a 3-month forward will be given to you something like this, 21.29. Okay, and obviously this will not make sense. I mean, what do they mean by 21 and 29, right? But it could also be 21.45 and 29.63. So what do you really mean by this? So what you really mean by this is that these are called forward points. Okay, these are nothing but pips, point in percentage. So if you want to know what is a 3-month forward rate, it is simply going to be 0.8692 plus 21.45 divided by 10,000. That's it. Okay. So that's going to be how much? Let's do it. $21.45 divided by 10,000 plus 0.8692 will give me 0.871345, and this will be 29.63 divided by 10,000 plus 0.9135 will give me 0.916463. So this is typically how forward quotes are given. Okay, I hope you've understood this. Okay. Then compare an outright forward versus a FX swap. So let me again simplify this for you. So easier way to think of this, imagine you're a guy and right now you have no shirt on you. Okay, and you go to a shop and you say, I'd like to buy a shirt. I will like to buy a shirt. Okay, then you're doing a simple currency forward contract, no complication there. But if you're a guy, you're already wearing a fancy shirt. I don't know how to draw a shirt. Okay, so if you're wearing a fancy shirt, does it look like a shirt to you? And if you go to a shop, okay, shop is a dealer here, and you would say, I would like to do two things. Number one, sell my current shirt. Number two, get me a new one. Okay, so when you're doing this is called as a FX swap. Okay, so even though it's called as a swap, technically it's not a swap. You need to distinguish between a currency swap and a FX swap. So when they say FX swap, it is not a traditional swap that we think of. It is actually this transaction where you're selling your current currency forward, closing in the position, and then you're building a new one. So now read the theory. Hopefully this will make a little bit of sense to you. Outright FX, when two parties agree to a transaction on a given date. A FX swap transaction is more complex because it involves two steps. Buy and sell FX in the spot market, buy and sell FX in the forward market. Spot market means sell my current shirt today and get me a new one in the forward market, right? Close out existing position, create a new position. It's more like a rollover type of a trade. So when you want to do these two transactions in one go, you can do a FX swap. That's it. It's that simple. Okay. Moving on. I hope you're gaining momentum. I hope you're with me. Next two learning outcomes. Let's see what we have here. Define and describe different types of risk. Okay. Transaction risk, export and import. Currency exchange for another at a future date. Receivable or payable. Import, export, easy. Translation risk means you have a foreign subsidiary, financial statement in a foreign currency. So you want to convert that. There are accounting rules. For example, I think a great example today, if you've heard of this company called Dr. Reddy's. Now, Dr. Reddy's have a very large subsidiary in Russia. And we know what has been happening with Russia and Russian currency, right? So that risk might come on Dr. Reddy's Indian books because they have that subsidiary there. That's called as a translation risk. And economic risk means a great example will be, if let's say, if Indian rupee appreciates, then Indian IT industry will lose business. Why? Because their products will become too expensive. Their services will become. Indian IT industry will lose business. Their products will become too expensive. They will not be competitive. If Indian rupee depreciates, then oil will become too expensive. So that's called as an economic risk. Then we go to multi-currency hedging. Describe the rationale for multi-currency hedging using options. So in general, your curriculum is of the opinion that if you have multi-currency exposure, you can use options. Options are better. There's a little bit of technical theory here. So I'm going to take you through this slowly. Make sure you get good hang of it. A multinational firm faces risk from multiple currencies, which is a good thing in a sense because changes in different currency have a correlation of typically less than 1. Lower correlation, lower volatility. Simple rule. Here's a sentence. A portfolio of currency risk is reduced compared to risk of a single currency. The use of options is recommended. Okay. The use of options is recommended if you have a basket of currency exposure. Why is that? You get downside protection and you keep the upside benefit. Correct? If it falls down, options will protect you. If it goes up, you don't have to exercise, right? But what's the loss? Loss is the premium. Okay. Now here's also an important one. In terms of timing, multinational firms often have monthly exchange rate risk. So purchasing option with monthly maturities is one alternative, which is costly. Correct? You can buy an option every month. A smarter way to do it, sorry. A smarter way to do it is simply buy Asian options. Why Asian options? Because they use an average price throughout the maturity. So they kind of give you a little bit of exposure to everything. Less costly alternative is to buy Asian options, which have strike price based on average exchange rate during the year. That's it. All right, moving on. Identify and explain the factors that determine exchange rate. So what determines exchange rate? Balance of payment, monetary policy, inflation, 3 variables. Okay, I'm going to summarize each one of them for you. Okay. Balance of payment. Simple logic. If a firm is exporting more than importing, then its currency will appreciate because there's a demand for that currency, right? So currency will appreciate, and the other way around. That's your balance of payment. Now, exporting more than importing is typically referred to as a trade surplus. It's called trade surplus. So if there's a trade surplus, currency will appreciate. Monetary policy. If a country has increased its money supply, that means they're printing too much of currency. Okay. If the money supply has gone up, then the currency will depreciate. The currency of that country will depreciate in theory. Okay. And maybe in practice. And finally, inflation. If a country has a higher inflation, what do you think? If a country has a higher inflation, then currency will depreciate. That's it. So these are your 3 important elements that you need to know here vis-a-vis exchange rates. Okay. Now calculate appreciation and depreciation of currencies. I'm going to give you an example. I want you to do that calculation for me. Let's say the CAD USD rate is given to you as 0.9215 today. Okay. And plus 1 day. Next day, the rate goes to 0.8725. Now, I want you to give me a percentage delta on CAD, and I want you to give me a percentage delta on USD. Can you do this? Can you calculate a percentage delta on Canadian dollar and percentage delta on US dollar? Start. Sorry. Okay, here's how you do this. Remember this trick carefully. Whenever you want to do currency appreciation, depreciation, you first have to figure out which is the base currency. Okay, this is the base currency. And which means this is the price currency. Now, if you're doing calculation on base currency, the formula that you want to use is closing divided by opening minus 1. Closing means the later on price. So closing by opening minus 1. So here it will be 0.8725 divided by 0.9215 minus 1 is equal to, let's see how much this turns out to be, 0.8725 divided by 0.9215 minus 1. I'm getting a negative 5.31 or 32 percentage. Now here USD is the price currency. If you're doing calculations on the price currency, the formula you want to use is opening by closing minus 1. Okay, opposite. So here it's going to be 0.9215 divided by 0.8725 minus 1 is equal to. So 0.9215 divided by 0.8725 minus 1 equal to. So that's going to give you a 0.5616 percentage. So that's how you do percentage appreciation, depreciation on the currency quotes, depending on whether it's the base currency or whether it's the price currency. All right, moving on. Next section is purchasing power parity. Easy, you should be okay here. Let me explain what this means. It's very simple. Let's say that if India has an inflation, okay, of 8%. Let us say US has an inflation of let's say 5%. So India has a higher inflation. What PPP tells you is, PPP tells you that Indian rupee, because of higher inflation vis-a-vis US dollar, will depreciate. Indian rupee will depreciate. By how much? By approximately of 3%. Indian rupee will depreciate by 3%. This is what purchasing power parity tells you. So the country with higher inflation, that country's currency will depreciate by 3%, because 3% is the delta of the two. That's it. That's your PPP. Okay, simple, straightforward, easy. Now, next learning outcome. This is on something called as a Fisher relationship. Nominal and real interest rates. Okay, let's see what the Fisher relationship is. Again, simple. International Fisher relationship. What does it tell you? Let us say India has an inflation of, let's say 8%. Okay. India has a real interest rate of let's say 4%. What Fisher relationship tells you is that the nominal interest rate in India, okay, will approximately be, nominal interest rate in India will approximately be 8% plus 4% is equal to 12%. That's it. That's what Fisher relationship tells you. If I want to do a precise nominal rate, not approximate, but if I want to calculate a precise nominal rate, then I have to chain them geometrically, which means I have to do 1 plus 8% into 1 plus 4% minus 1. So that would be 12.4, sorry. So 12.32%. Please cross check if I've done the maths right. So that should be 12.32%. That's your nominal precise rate. That's it. That's what the relationship between nominal and real interest rate is. Okay, I've put in a little bit of theory for you to read. You can. Bond YTMs are always nominal. Yes. Okay. Moving on. Next concept is interest rate parity. Okay, this is going to take me a little bit of time to do. Let's call it a day here. I would have liked to finish this today, but I think my throat is troubling me a bit. So tomorrow we'll stretch it maybe an hour longer to finish. We've done most of the technical part, but after this we have to spend some time on interest rate parity calculation. So I don't want to rush through it. So tomorrow what we'll do is we'll probably push it by 30 to 60 minutes. We'll see how things go. We'll start at the usual time. We'll be starting at 5 p.m. and then we'll go on till 9:30ish or somewhere in that ballpark. Is that okay? So for today, the session is over. In about 60 minutes after the session gets over, you'd find a PDF available in the description box of the YouTube. So you can download today's class notes up to the point where we studied, which is up to this nominal and real interest rate. And tomorrow onwards, all the session will happen on the Zoom link. I hope the Zoom link have been shared with you. I hope all of you who have signed up for the course or who have access to the FinTree module have already received Zoom links. If you've not received the Zoom link, then I'll share it on your WhatsApp groups. Okay, so you should be able to get access to it. If you do not get Zoom links tomorrow by let's say 4 o'clock, you can write us an email on the support email ID or admin email ID. So we'll send you the link separately. But most of you will receive the link any which case on the Zoom chat box itself. These notes I will be uploading on the LMS as well. Yes, I will upload the notes on LMS too. Only till the part we've already done in the class. No, Abhinav, tomorrow onwards, I think for next 4 days, the sessions will be closed. So it will not be available on YouTube. For live school, is it the same link? No, we have a dedicated link for the crash course. So my team will share that link with you. We'll share it on the admin chat box if that's okay. By the way, I hope you're finding this useful. I've been very careful to make sure you get good return on the time that you're investing. If you have any, most of you have my personal number. So if you have any suggestions or if you want me to spend more time on something, less time on something, if you want me to kind of speed up, go slow. If you have any suggestions, feel free to WhatsApp me directly or put them in the whatever chat box or description. I'll try to incorporate as much as possible. But are you finding these sessions helpful? Good. Good. Happy to know it's helping. All right then. So happy Dasera Varun, please don't call me for till next Sunday. I'm kind of trying to save my throat as much as I can, but you can WhatsApp me. You have my WhatsApp number. Sure. Thank you very much. I appreciate the feedback. Keeps me motivated. Happy Dasara one more time. I'm a little under the weather today, but I think I should be okay with. I should be. Say you don't read WhatsApp chats. I know. I'm so sorry, Vedant. Yeah, it's been very overwhelming. It's just too many WhatsApp messages. I want to read them. And honestly, I'm not being able to handle. I'll do better. I'll try to do better. Yeah, sort of. We can try to do it tomorrow onwards, maybe on the Zoom, if the time permits. We'll try to do 10 minutes for the doubts, 10-20 minutes for the doubts. We'll see how it goes tomorrow. Okay. All right. Thank you very much. Okay, Pankaj, that's sweet. Thank you very much. You guys keep on studying. So as I told you at the beginning of the session today, I hope you made a list of all the areas that you're struggling with. So go back to the videos, to the notes, whatever, and make sure you work on all the weak areas. Okay. Take care. Thank you very much. I'll see you tomorrow evening, 5 o'clock on the crash course link on the Zoom. Thank you.